Hey everyone, Cal Ewing here, and in this video I'm excited to go through a brand new note that I just Hey everyone, Cal here, and in this video I'm excited to go through and break down some of the details of a new note that I purchased in the last week. We just completed the funding process. We're getting the assignment of mortgage recorded, all of that fun stuff, and I thought it would be a good time to break down all of the details on this non-performing note that I just purchased. I'm going to go through some of the exit strategies that I have available to me now that I own this note, what the numbers look like on this note, expected return on investment, that kind of thing. So buckle in, we're going to review it right now. Let me share my screen. All right, so as I mentioned, this is a non-performing note that my company just purchased. My company is 49th Parallel Properties. So we just acquired this note from a hedge fund. They were selling off a portfolio of, I think it was around 73 notes. It was a mix of performing and non-performing. And this is a bid that I got accepted just recently. And then we funded the purchase last week. So we're just tying up the loose ends. We're transferring servicing from their servicing company to my servicing company. We're recording the assignment of mortgage with the county, doing all of that. Okay, but here's the property here. So it's a property located in Round Rock, Texas, which is a suburb to the north of the city of Austin, Texas. This house, as you can see, is in really great condition. It's a newer home in a really nice neighborhood. It's occupied right now. And yeah, I loved everything I saw when I saw the neighborhood and the property and the location. And as many of you know, Texas is a great place to buy mortgage notes because of the fact that it's the fastest foreclosure state. Okay, so in Texas, if you are a lender and your borrower stops paying, you have the ability to foreclose on that borrower if needed, faster than any other state. Okay, so we're talking like three months, 6 months if it goes long, kind of thing. It's a non-judicial state, and you can get going on foreclosure incredibly quickly, which is nice, knowing that you've got that option as a note investor. Okay. So just a quick look at the map. So here's Austin here, and then up at the top there's Round Rock. Okay, so it's I guess like a suburb city or community that's part of the greater Austin area. And as many of you probably know, Austin has been one of the fastest growing cities in the US for a number of years. I think it's slowed down a little bit this past year, but it's been growing like crazy. It's becoming a major tech hub. A lot of people are moving from other states. And so I love that about this is that it's a hot market. Real estate prices have gone up very steeply in the past, 5-10 years. And so this is a great area. I'm happy to be buying a note here. And I actually have a friend who lives nearby who was able to check out this property for me, get his own eyes on the property. Okay, so let's look at some of the details here. So the address, 1560 Clary Sage Loop, and it's a 4-bed, 2.5 bath home, and pretty decent size, and it was built in 2006. Okay, so 18 years old. So pretty new in my standards, a nice looking little home. So the mortgage details on the note that we just purchased. So this is a first mortgage in first lien position, okay? Non-performing, meaning that the borrower has not been making their mortgage payments for quite some time. Okay, they have not made a payment. They made a payment last October in 2023, but that payment went towards their March 2023 payment. So they are basically 18 months behind at the time of recording this video. Okay. So the legal balance, so that is the total amount that the borrower owes to completely pay off this mortgage. So that includes the unpaid principal that they've yet to pay. It includes all the missed payments and interest. It includes late fees. It includes corporate advances. So this is when the lenders had to pay taxes, property taxes, insurance, other things like that, all the charges that go into basically keeping this loan in place and keeping insurance and taxes paid. Okay, so the total amount the borrower owes is $233,000. Okay, and the annual taxes, property taxes on this property are $3,000 a year, and they've already been paid for this year. The property value, so we actually had a broker price opinion done on this property, came in at $495,000, okay, plus or minus. So you can see here right there, the borrower has equity. So if the house is worth basically 500,000 and the borrower owes 233,000, you can see that they have like a little bit over 50% equity, or 50% loan to value, essentially. Okay, so they've got a lot of equity there as security, and they're paying, when they were making their payments, they're paying 5.47% interest, which works out to a $900 a month payment. Okay, that's principal and interest. Now, this borrower originated this loan in 2008. Okay, that's when they first took out this mortgage. They ended up modifying and getting an extension, basically changed all the terms. They dropped the interest rate down to 5.47, started a new 30-year term in 2011. Okay, so they modified the entire loan in 2011. And I think that actually corresponds to the time when one of the borrowers passed away. So right now, the Mr. passed away in 2011. His spouse is currently living in the home, and then they have two children, adult children that I believe I found out were living out of state. Okay, so looks like it's just been a tough haul, as is common. You know, when one spouse passes away, it's hard for the other one to make the payments, and that looks to be the situation here. So I bought this note for $145,000. Okay, so if I buy a note as a note investor, the borrower essentially now owes me, or my company, $233,000 on a purchase that I made to buy the note for $145,000. Okay, so you can see that there's like 90,000 or whatever spread there. Okay. So keep in mind, when you're buying mortgage notes, you're not buying the house. We're not buying this property, okay? We are buying the debt. We're buying the mortgage. And now it's like buying an IOU, right? So I bought the IOU for $145,000, but the borrower owes me $233,000, okay? So we're not really looking at recouping the $495,000 here. We're looking at recouping the $233,000. Okay. So I've got a few different exit strategies available to me now that I own this note, and I'm going to break down kind of what they all are for you. Okay. So number one is to try and keep the borrower in her home. Okay. I want to make sure that we do this fairly, but also I want to give this borrower the opportunity to have the easiest exit possible, both financially, credit-wise, being able to walk away with the most amount of money, all of those things, okay, when we look at an exit strategy for this note, okay? So the borrower right now is 74 years old. I'm buying it for $145,000, as I mentioned. So we could have the borrower try and reinstate the loan. So that means basically pay off what's owed, all the missed payments for that 18 months, and then just start making payments again. So reinstating the loan, getting it back on track, okay? I don't know if that's very likely because that's a lot of money that they're now behind. And so they may not have the money to do that, because if they did, they'd probably be making their payments, right? So in this case, though, if they were able to do that and they started making their $900 a month payment again, in 1 year, that would be $10,800 in income, okay? So, and if we consider that we bought the note for $145,000 and we're earning $10,800 in a year, that's only a 7.4% annual return. Okay, not great. It's not really why I'm in the business of note investing. Okay, there's other easier, safer ways to make a 7.4% return, right? So now keep in mind, though, that to get them to reinstate, we would require that they pay that 18 months of missed payments up front. Okay. So that would be another $16,200 in back payments or missed payments. So if you were to add that to the $10,800, so let's say they came up with the 18 months of missed payments, which is $16,200, and then for the next year they made their payment on time for 12 months. That would work out to $27,000 in profit. Divide that by $145,000 purchase price, the price we paid for the note. Now we're talking a little bit. It's 18.6% return in that first year. Okay, so that's pretty good. That's really nice return. But then the following years, it would go back down to a 7.4% because then they'd be back just making that payment of $900. Okay, so I'm not in love with that. If the borrower did have that amount of money and they did want to reinstate, that might not be bad because it would be an 18.6% return. And then perhaps we could sell the note in subsequent years, okay, to another hedge fund or something like that, okay? So I don't see that happening. I don't see the borrower having that money and being able to do that. So I think this option is off the table. I don't really want to go this route either. So I think both from the borrower's perspective and my company's perspective, it's not really in the cards. But that is one option, okay? Okay, this one's more realistic. So as I mentioned, the borrower is 74. So she actually would be in a decent position to qualify for a reverse mortgage, okay? So my first step and my first, I guess, strategy that I'm going to try to do with this borrower is to see if we can get her refinanced into one. Okay. Now, when I was looking through the servicing notes from the previous note owner, the entity that sold me this note, they had mentioned the borrower should get a reverse mortgage. And based on the notes, it said that she tried, but she didn't get anywhere with it. And I'm wondering if maybe because of her age, maybe she just didn't have any help and she got stuck. So I'd like to see if we can maybe work with her to get that done and maybe hold her hand a little bit more through that process because she's got a lot of equity, right? And she's of the right age that she could qualify. And so what would happen is if she gets a reverse mortgage, then my mortgage that I bought that's on this house would get fully paid out. So we get paid the 233. Okay, she'd have a new reverse mortgage, and then she could stay in her home, and everything would be good. Okay, so in that case, it would benefit her, and it would benefit me as well. So in this case, we get paid the 233 when we get refinanced out, minus the purchase price of 145. So that's an $88,000 profit. Okay. And that if we were to get that done in 12 months, which I think is doable, easily doable, that would be a 61% return. So that's something I'm going to work for. If she wants to stay in her home, that might be a good way for her to do it. Okay. All right. The other option, because she hasn't been paying, is we do have the legal right to go through and foreclose on this borrower. Okay. And like I said, I'd like to try the other strategies first. And then if that doesn't work, if they're non-responsive, they're not willing to work with us, then we would go the foreclosure route. Okay. So as I mentioned, this is a fast foreclosure state. We could probably foreclose in about 3 months. We'll use a 6-month time frame just to run our numbers in case things get slowed down a bit. But basically, I think because the house is worth $495 and we put it up for auction, this thing is going to sell way above the amount that the borrower owes. Okay, so the borrower owes $233. If we sell this at the auction, I don't see why a house in this neighborhood in this condition wouldn't sell for, high 300s. Okay, or wait, $495, mid 400s probably is what it would sell for. Okay, so if you are a note holder, if you're the bank and you own a note, okay, and then you foreclose and that house gets auctioned off at the auction, at the foreclosure auction, okay, you get paid the legal balance. So we would get paid this 233. Anything above that, if the house, let's say the house sells for 400, okay, well, the borrower, she would be able to claim that additional equity between what it sold for and the payoff of this mortgage, okay? So what's that, like 170,000? Okay, so she would actually be able to recover that equity after the foreclosure. Okay, so we don't get that all that equity. We would only get the 233, and so that works again out to a 61% return if it took an entire year to foreclose. But in this case, it's going to be 6 months, so I'm expecting 121% return. So that's kind of why I do this business. Between that. Anywhere between a 60% and 121% return is great, obviously, okay? The 7.4%, not so much. Okay, the other option we could look at doing to help her avoid a foreclosure, because that's gonna affect her credit for the next 7 years, is negotiating a cash for keys or a deed in lieu of foreclosure, okay? So that's a way of skipping the whole foreclosure process. So basically what I would do is offer her 65% of the value of the house, okay, which would be $325,000, okay? so she's able to get more of her equity. She basically, we'd pay her the 325 minus the amount that she owes us on the mortgage, right? So 325 minus the 233. So she'd be walking away with 92K. All right. And then she'd deed us the property. And then, we could either renovate it and sell it. We could sell it as is. We could keep it as a rental. We could owner finance it and then create a brand new mortgage note. So there's a lot of options once we own the property because we're getting it at such a good price, basically 65 cents on the dollar. Okay. So the borrower would do well because she would walk away with $92,000 in cash, and we would get paid out. We could sell off the home. She doesn't have to go through a foreclosure and have that on her record, and everything's win-win. Okay. And if we did rent it out, this house would rent for $2,600 a month. Okay. So that's another option. So you can see with note investing, there's a lot of options on non-performing notes, a lot of ways to profit while also working with the borrower to help them out as well. And here's just a quick snapshot of Rent-O-Meter. So the average rent's $2,400. Okay. Okay, so this particular deal, I actually ended up working with a funding partner, and they actually put up the funds to purchase this note, and then they're making a nice return as a private lender. They're making double-digit returns on their money. We were able to buy this note, and then when we complete our exit strategy, whichever one we end up doing, we pay out our private lender, and they earn their interest rate, which is, again, above 10%. It's double digits, and so they make a nice return. Their investment secured to that nice house in Texas. And we are able to do the deal. And then, of course, we're going to profit from it as well. So by working with funding partners, these are just people with funds in their IRA accounts. These are people like doctors and engineers and dentists and people that have money that they'd like to lend out and make a nice return, but they also want it secured to a tangible physical asset like real estate. If you're one of those people, let me know, because you can take part in future deals like this that come across my desk. And it's a really good way if you're not really, maybe you're a very busy person, you don't have time to find these kinds of deals yourself, or maybe you feel like you don't know how to find these kinds of deals. You can still get involved and make a nice return by being a funding partner on one of these deals. Okay. So as a funding partner, for a non-performing note deal like this, where there's a short-term exit plan, you'd be earning somewhere between 9 and 12% interest. Typically, for non-performing deals, it's 12 months. If it's a performing note deal, this is a longer-term investment. You probably want to be considering having your funds tied up for about 3 years, okay? And we would just be collecting the monthly payments, okay? But either way, whether it's a non-performing or a performing note, when you make a private loan like this with our company, your investment is secured to that piece of property and to that note, which has value. Okay. So if you're interested in getting involved in something like this, we'd like to have a conversation and just answer your questions. I'd like to get a little bit more information about you, what your goals are, that kind of thing, if you're accredited or not, and go from there. Okay. So if you're interested in taking part in one of these deals like this, please reach out to me. You can contact me by going to talkwithcalewing.com, and it'll allow you to schedule a call with me. You can just go to my calendar, book a call, and we can set up a time to answer all your questions. You can answer some of mine. We can discuss the benefits and drawbacks of note investing and see if it's a fit for you. Otherwise, if you're a note investor, and I hope you found some value in this, or if you're looking at getting involved in notes, I hope you found some value in this kind of thing. Note investing is a great space to be in right now. I'm pumped about it. I like it more than a lot of other real estate investment strategies that I've done in the past. And so I hope this video is valuable to you. And if you like it, please give me a thumbs up or a like wherever you're watching this. Post some questions if you want in the comments, and stay tuned for the next video. I like to record lots of videos like this of some of the deals I'm doing. So make sure you follow my channel.